This stock is about sales plus 44%, EBITDA plus 50%. Growth is real. And I don't mean slightly under the radar. I mean barely 3 analyst reports exist on this company. No one is talking about it. No one is covering it. But here's the thing. While everyone was busy chasing the next AI stock or the next big IPO, this company quietly posted its best quarter ever. And the market still hasn't noticed. Stay till the end, because the insight I'm about to share will completely change how you look at this sector. So what exactly is going on here? There's a mid-cap fintech operating in a space called corporate spend management. Now that sounds boring, but stick with me. This company manages prepaid cards and employee benefit programs for some of India's biggest corporations, banks, and NBFCs. Think of it this way. Every time a company gives its employee a meal card, a fuel card, a travel allowance, or a gift voucher, this company is the infrastructure running underneath. And in their latest quarter, March 2026, they reported revenue of 593 crores. That's a 44% jump compared to the same quarter last year. 44% year over year. That's not a rounding error. That's not a one-time bump. That's a business firing on all cylinders, with zero fanfare from the market. Okay, but why should you care about a prepaid card company? Here's the bigger picture. India's corporate spend digitization is a 5 lakh crore opportunity. Most of that money, still moving through cash, checks, manual reimbursements, is about to go digital. Regulations are pushing it, companies are demanding it, employees are expecting it, and this company is already embedded inside that transition. 3 things make this especially interesting. 1, their revenue model is sticky. Once a large enterprise signs on, they don't leave. The switching costs are too high. It's almost SaaS-like in nature. 2, this is a near zero competition niche. Very few players can operate at this scale, with the compliance, the RBI approvals, and the enterprise relationships this company already has. 3, almost no one is researching it. That's not a red flag. That's an opportunity. Because when institutions eventually discover it, and they will, the re-rating can be sudden and sharp. Now, here's the part most people miss. The market is looking at this company and saying, oh, it's a prepaid card issuer. Nice, moving on. That is the wrong frame entirely. This is not a card company. This is a platform. Let me explain. Every time an employee swipes that company-issued card, this business earns on the transaction. Not once, not twice, every single time. Now, multiply that by hundreds of thousands of employees across thousands of corporate clients. That's a transaction engine, not a product sale. And then layer on the network effect. More enterprise clients means more cards issued. More cards issued means better interchange rates from banks. Better interchange rates mean higher margins. It compounds. And then there's the third piece, regulatory tailwind. The RBI has been pushing hard for digital salary payments. That's not a vague future trend. That's happening now. And every new mandate on digital disbursements is a direct, immediate tailwind for this company's core product. The market is pricing it like a card issuer. It's actually a fintech platform. That gap, that mispricing, is exactly where the opportunity lives. Let's talk numbers, and I'll keep this simple. Revenue for March 2026, 593 crore rupees, up 44% from 411 crore rupees just a year ago. EBITDA, that's operating profit, came in at 54.8 crore rupees, up 50% year over year. 50%. That's EBITDA growing faster than revenue. That's operating leverage kicking in. That's unusual. Net profit, 37.8 crore rupees. EPS, earnings per share, at $2.81. Now look at the trajectory. March 2025, 411 crore rupees revenue. December 2025, 498 crore rupees. March 2026, 593 crore rupees. 3 consecutive quarters of acceleration. Not deceleration, not a plateau, acceleration. When you see a mid-cap growing at this pace, consistently, quarter after quarter, you have to ask yourself, why is nobody talking about this? So what actually moves the stock from here? There are 4 things I'm watching. First, any new bank or NBFC partnership announcement. Each new enterprise client is a step change in cards issued. One deal can move the needle significantly. Second, analyst coverage initiation. Right now, almost no major brokerage covers this company. The day a Motilal, a Nuvama, or a Kotak initiates coverage, this stock gets discovered by an entirely new set of institutional investors. That re-rating can happen overnight. Third, any RBI policy update on mandatory digital salary payments. Every new circular in that direction is free revenue for this company. And fourth, continued margin expansion. EBITDA grew 50% against 44% revenue growth. If that gap widens further over the next 2 quarters, the growth investor community will start paying very close attention. Watch for any of these 4. Any single one could be the catalyst. Now, I have to be honest with you, because no stock is perfect, and I won't pretend otherwise. Here's the one risk that keeps me watching carefully. Net profit grew only 18%, while revenue grew 44%. That gap is telling us something. Costs are rising faster than profit. Could be sales headcount, could be tech infrastructure, could be both. If this pattern continues, if margins stay compressed, growth investors will lose patience, and the stock will get repriced downward. So what am I watching? The EBITDA margin percentage every single quarter. As long as it's expanding, this thesis holds. If it starts shrinking, that's the exit signal. The risk is real, but it's also knowable and trackable. That's actually a good kind of risk to have. So let me bring it all together. A company operating in a 5 lakh crore digitization wave. Platform economics with sticky, recurring revenue. 44% revenue growth, 50% EBITDA growth. 3 quarters of consecutive acceleration. Under-researched, under-owned, undervalued. Still early, still ignored, still growing. This is not a stock tip. Do your own research, talk to your financial advisor. This is analysis, not advice. But if this gave you a new idea to dig into, like this video, subscribe, and drop your target price in the comments.